Okay, let's get right into it. If you've ever stared at an annuity statement and just felt your head start to spin, you are definitely not alone. It's usually packed with numbers, and trying to figure out what's what can feel impossible. But today, we are going to clear all that up.
Does this question sound familiar? You're looking at maybe 5 different dollar amounts: account value, cash value, benefit base, and you're just thinking, okay, but which one of these numbers is my money? It's the number one question people have, and for a really good reason.
So why is it so complicated? Well, unlike a simple bank account that just has one balance, an annuity is actually an insurance contract. And that contract comes with a bunch of different separate promises. There's a promise for how it might grow, a promise for your future income, and maybe even a promise for what your family gets. Each of those promises needs its own number to keep track of it.
To make this all make sense, we're going to use a really simple analogy that just cuts right through all the jargon. I want you to think of your annuity not as one big pile of cash, but as a wallet that has 5 different pockets inside.
Now, the thing about this wallet is that each pocket is built for a very specific job. You can't just take the money that's set aside for your retirement paycheck and use it to buy groceries today. And this whole idea, this separation of jobs, is exactly why you see all those different values on your statement. Each one is just a different pocket.
So let's quickly look at these 5 jobs. You've got a number for tracking growth. You have a walkaway number, what you get if you just leave. There's a future income number, a legacy number for your heirs, and one that acts as your absolute safety net. We're going to break down every single one of these.
All right, let's get to the main event here. We are going to decode the most important values you're going to see on that statement, one by one, and we'll connect each one back to the specific job it's supposed to do.
First up, the big one, the account value. Sometimes it's called the accumulation value. This is the one that most people tend to watch. Think of it like the big number on the scoreboard. It shows what you put in, plus all the interest or gains it's made, before we talk about any potential penalties. This is your growth number.
So for example, if you put in $100,000 and it earned $5,000 in interest, your account value is $105,000. Pretty simple, right? This is the number you glance at to see, hey, how's my investment doing?
But here is where everybody gets tripped up. The cash value, or surrender value, is a different beast. This is your walkaway number. It's the actual, real-world amount of money you would get in a check if you decided to tear up the contract and cash out today. And this right here perfectly explains the biggest confusion. Your account value might be that nice $105,000, but if your contract is an $8,000 surrender charge for cashing out early, your cash value, the check you can actually deposit, is only $97,000. So here's the key. Account value is what you have on paper, but cash value is what you can take right now.
Okay, let's just pause for a quick summary. This little table puts the most important values side by side. You can see the account value is for watching your growth. The cash value is all about liquidity for emergencies. Then there's the benefit base, we're getting to that next, which is strictly for income math. And of course, the death benefit, which is for your estate plan.
Okay, now for the benefit base. This one is, hands down, the most misunderstood number of them all. The best way to think of it is as a phantom number. It's not real money, you can't spend it, its one and only job is to be used in a math problem to figure out your future paycheck.
And I really have to hammer this point home. This is probably the single most important thing to remember about this value. You cannot walk away with it, you can't withdraw it, you can't cash it out. If your benefit base says $150,000, that does not mean you have $150,000. It is just a tool for a calculation.
So how does it work? Well, it's just simple multiplication. The insurance company takes your benefit base, let's say it's grown to that $150,000, and they multiply it by a payout rate that's written in your contract. Let's say that rate is 5%. Boom! That gives you your guaranteed lifetime income of $7,500 a year. That's all that number does.
Next, we have the legacy number, which is just the death benefit. Now, this one's pretty straightforward. It's simply the amount of money that is guaranteed to go to your beneficiaries when you're gone. And a really key feature here is that it often guarantees at least what you put in, even if the market tanked and your account value is lower.
And finally, there's the safety net number, or the guaranteed minimum value. This is your contractual floor. It's the promise from the insurance company that no matter what happens in the markets, your contract will never, ever be worth less than this specific amount. It's all about peace of mind.
Okay, so we have officially defined all the different pockets in our annuity wallet.
Now, let's put this knowledge to work and see how you can use this to answer your most pressing financial questions.
This is where the rubber meets the road. If you're asking, how's my investment doing, you look at the account value. If you're thinking, what happens if I need a chunk of cash for an emergency, you check the cash value. Planning that retirement paycheck for life, you need the benefit base. Thinking about what you'll leave behind, that's the death benefit. And if you want to know your absolute worst-case scenario, you look at the guaranteed minimum value. See, every question has its own number.
So, after all that, what is the big takeaway here? Let's just wrap this all up with the single most important point.
Look, these numbers are not there to confuse you, even though it totally feels that way sometimes. The truth is, every value tells a different part of your money's story. They're not fighting with each other. They're specialized. One is for growth, another is for cash on hand, and another is for a paycheck you can't outlive. They just have very different jobs.
And that brings us to this critical piece of advice. Whether you're thinking about buying an annuity, cashing one out, or finally flipping the switch to start your income stream, you have to be absolutely sure which of these values actually applies to what you're trying to do. Getting it wrong can be a really expensive mistake.
So, I'll just leave you with this one question. Now that you know what each pocket in your annuity wallet is for, think about your own situation. What's most important to you? Is it growth? Is it guaranteed income for the rest of your life? Is it leaving a legacy? Because your answer to that question will tell you exactly which number on your statement you should be paying the most attention to right now.